Joining us now for a look on the ground is Doug Suttles, Ovintive CEO. Ovintive is a U.S.-based oil and gas producer. Doug, it's great to have you with us. Thank you so much for joining us. If you told me 6 months ago Brent would be at 70, I probably would have called you crazy. That's probably why I'm not in the market. So you've paid down debt, you've restructured your balance sheet, you've been selling off non-core assets to kind of get your financial liquidity position in a good place, and now you have oil at 70. What do you do with all this extra money?
Well, actually, Alix, it's a great place to be. And, you know, the other thing I just mentioned, add to your comments there is our sector now has been the #1 sector in the market for 2 quarters in a row. So it's great to see some recognition of this. But I think the theme is very clear. The industry's really adopted a new business model, one of low growth, which matches the world demand, combined with strong operating performance and returning cash to shareholders. With us, the priority's been on paying down debt and maintaining our dividend, but it puts us in a great place. I mean, we generated over $500 million of free cash flow in the first quarter.
Doug, morning, it's Guy. That's probably the case, and it certainly is the case if you're a listed company. And we hear what you're saying from a number of businesses of similar size to yourself. My question is, if you're smaller, if you're private, if you've got an oil price at 70, the incentive to drill is going to be absolutely massive right now. How does the industry deal with that two-speed situation?
Yeah, it's good. It's a good question, but actually probably the one piece to add to that is that the privates, in terms of their oil production in the United States, is pretty modest now. Many of them have been sold, have been bought by the public companies. So their ability to move the total global market is now quite small. Bit of a different story in natural gas in the United States because they have a bigger piece of that market. It is a little bit of a concern, but I don't think it's a big one. I think you're going to see discipline across the sector. We're still in recovery mode. I mean, we're seeing strong demand growth as economies reopen and the world becomes more normal. We know that's not everywhere yet, but I think until the world fundamentally needs growth from the industry, I think you'll see this discipline hold.
What we have seen, though, which is interesting, Doug, is a lot of M&A. Under what kind of circumstances would you think about selling yourself now that you've kind of gotten your financial structure in order?
Well, you know, Alix, every company, whether you're an oil and gas company or any company, always has to do what's in the best interest of its shareholders and the long-term value of the corporation. So if we ever felt like that was in that best interest, we would actually do that. We don't believe that today. We believe we've created a great foundation to unlock a lot of value. You probably know that I mentioned earlier, the sector's done well. We've outperformed the sector by a factor of 2x this year so far. So I think the best path for us today is to continue to drive performance like we have been, expand margins, increase returns, maintain the scale of our business. And of course, what we've been doing is paying down debt, and what we've seen that do is be reflected in the value of our equity. Okay,
so maybe is what I'll take away from that, Doug, for a sec. The other thing the industry has to wind up contending with is what happens if oil and gas subsidies go away in D.C. and you have to deal with higher corporate taxes. And specifically, I'm interested if that's going to raise the cost of production for the shale industry in particular, and then how that winds up impacting growth.
Yeah, and I think, Alix, there's a bunch of sort of misunderstanding here. I mean, a lot of the talk has always been about what's called IDCs or intangible drilling credits. But that's actually just about the rate at which we accelerate the depreciation, or the rate at which we depreciate capital that we've invested in the business. It's actually not a subsidy. It's just the pace at which we're allowed to depreciate that capital.
But it helps, Doug, but it really helps.
It does, but it does wash itself out. I think what's really important here, and it's actually the macro on taxes in the United States, if our tax environment corporately is not competitive, capital will leave the country. It will go to other places. That will actually impact jobs. It'll impact the domestic growth. It'll impact incomes. It'll impact government revenues. So I think as Washington explores this, and I do think there are calm minds there who will do this, they'll realize if we're not competitive with other parts of the planet, it will have a very negative impact on the country. In our industry specifically, we've worked for decades to become energy independent. We are now energy independent. We would not want to put that at risk, whether that's the jobs or the national security.
Doug, do you think you're going to be paying more taxes?
Well, I think it's reasonable that there may be some increase. I don't think the things that have been put on the table will actually turn out to be where we end up because of this competitiveness thing. But clearly, the country, as many countries in the world, have faced a lot of challenges over this last year and have had to inject a lot of money into the economy, and they have to find a way to pay for those things. So I expect there'll be some, but I think it'll be very modest. Otherwise, we won't end up with more taxes in total. We'll end up with less.